Most people believe money comes from work, from saving, from production, from something real. But that belief is one of the biggest illusions of the modern world, because the truth is simple and uncomfortable. Most money is not created by governments. It is not created by central banks. It is created by private banks, quietly, legally, out of nothing. And this did not happen by accident. It was learned, perfected, protected over centuries. To understand how banks learned to create money from nothing, we have to go back to a time before paper money, before credit cards, before digital balances on a screen. We have to go back to a world where money was physical, heavy, and limited. In medieval Europe, money was metal, gold, silver, copper. If you wanted to lend money, you needed to actually possess it. If you did not have it, you could not lend it. That simple rule kept the financial system grounded in reality. But it also limited power. Because whoever controlled money controlled armies, trade, and kings. Goldsmiths were the first to notice something important. People stored their gold with them for safety. They received paper receipts in return. These receipts were claims on real metal. Over time, people stopped redeeming those receipts. They trusted the paper. And the goldsmiths noticed something even more dangerous. Most people never came back for their gold at the same time. That was the moment everything changed. The goldsmiths realized they could issue more paper claims than the gold they actually held. As long as everyone did not ask for their gold at once, the system worked. They had discovered fractional reserve banking without calling it that. They were creating purchasing power from nothing, backed not by metal, but by trust. This was the original financial alchemy, and once discovered, it could not be undiscovered. Kings noticed, governments noticed, and instead of stopping it, they legalized it, because it solved a problem rulers always had. They could spend more than they collected without raising taxes. Banks became partners of power. In exchange for financing wars and empires, they received protection, monopolies, and legal immunity. By the time central banks were created, the system was already built. Central banks did not invent money creation, they standardized it. They became the managers of trust, not the creators of value. Private banks create money when they issue loans. This is not theory, this is accounting. When a bank gives a loan, it does not take existing money from someone else and hand it to you. It creates a deposit out of thin air. Your loan appears as money in your account, spendable, transferable, real. But it did not exist before that moment. At the same time, the bank records a liability, your obligation to repay. Money is born as debt. Every dollar in circulation represents someone's promise to pay. That is why modern economies are built on perpetual borrowing. If debt stops growing, money supply contracts. And when money contracts, economies collapse. This is why governments panic during recessions. This is why central banks rush to cut rates. This is why liquidity injections happen overnight. The system cannot survive without continuous money creation, and money creation requires debt. Banks learned this lesson long ago. They also learned something else. Risk could be socialized, while profits remained private. When banks make money during booms, they keep the gains. When banks fail during crises, the system steps in. Taxpayers absorb the losses through bailouts, inflation, and currency debasement. This is not a conspiracy, it is structure, and it explains why banking has become the most protected industry in history. Banks are not just financial institutions, they are infrastructure. If they fail, everything freezes. Payments stop, trade halts, wages disappear. So governments do not let them fail. This guarantee changes behavior. It encourages risk, leverage, expansion. Banks lend not because they have money, but because they are allowed to create it. The only real constraint is regulation, and regulation has always lagged innovation. Every financial crisis in history has followed the same pattern. Credit expands, leverage increases, assets inflate. Then something breaks. Confidence vanishes, credit contracts, and suddenly the illusion is exposed. But instead of dismantling the system, it is reinforced. Rules change, backstops expand, money creation accelerates. The lesson banks learned is simple. They are too important to be stopped. Over time, money became abstract, numbers on screens, digits in databases. Physical cash became a small fraction of total money. Most money today exists only as bank deposits, and deposits exist because loans exist. This means banks are the gatekeepers of economic opportunity. They decide who gets credit, who gets liquidity, who grows, and who stagnates. Not through malice, but through incentives. They lend where returns are highest, assets are safest, and power is already concentrated. This is why asset prices rise faster than wages. This is why housing becomes unaffordable, stocks detach from productivity, and inequality widens. Money flows to where money already is, because money is created by lending, and they lend to those who already have collateral. This is not a moral failure, it is a mechanical one. The system rewards balance sheets, not effort. And once you see it, you cannot unsee it. Governments borrow from banks, corporations borrow from banks, consumers borrow from banks. Entire nations are built on balance sheets. And because money is created as debt, there is always more debt than money available to repay. This forces perpetual expansion. Growth becomes mandatory, not optional. Environmental limits, social limits, human limits. None of these matter to a system that must expand or collapse. This is why financial crises feel inevitable. They are not accidents, they are pressure releases. Banks did not become villains, they became engineers. They learned how to turn trust into currency, debt into money, time into leverage, and they taught the world to depend on it. Today, when central banks raise or lower interest rates, they are not controlling money, they are influencing bank behavior. They are signaling, encouraging, discouraging. But the real creation happens inside private balance sheets. This is why monetary policy feels disconnected from real life. Rates change, but rent still rises. Liquidity floods markets, but wages stagnate. Because money enters the economy unevenly. It enters through banks and spreads from there. By the time it reaches the average person, its purchasing power is already diluted. This is the hidden tax of money creation. Inflation is not just rising prices, it is the silent transfer of value, from savers to borrowers, from labor to assets, from the future to the present. Banks learned to monetize time by lending tomorrow's money today and charging interest for it. This makes them indispensable, but also dangerous, because when trust breaks, nothing holds. This is why banking crises are treated like natural disasters. They are not allowed to fully play out. The damage would be too large. So the cycle continues. Debt expands, money expands, assets inflate, until the next correction. Understanding this does not mean rejecting the system. It means seeing it clearly. Money is not neutral, it is designed. And banks did not accidentally learn to create money from nothing. They refined it, legalized it, and built the modern world on top of it. The question is not whether this system works. It does. The question is who it works for, and for how long. Because systems built on infinite expansion in a finite world always face limits. And history shows us
those limits always arrive. Not suddenly, then all at once. If you understand how money is created, you understand why the world looks the way it does, why debt never disappears, why crises repeat, why power concentrates. Banks did not steal money from nothing. They learned to create belief. And belief is the most powerful currency ever invented. This is not the end of the story. It is the foundation, and everything built on top of it depends on whether people continue to believe.